Hello, and welcome to the Industry Think Tank on curating a conversation for a sustainable banking industry at the Risk Hong Kong Virtual Conference 2020. My name is Mushtaq Kapasi, and I am Managing Director and Head of Asia Pacific for the International Capital Market Association, ICMA. I'm joined today by two distinguished guests. First is Chaoni Huang, Executive Director and Head of Sustainable Capital Markets, Global Markets APAC for BNP Paribas, and also Secretary General for the Hong Kong Green Finance Association. I'm also joined by Eric Nietsch, the Head of ESG Research and Integration Asia for Manulife. I'd like to thank each of the panelists. Ask each of the panelists to briefly introduce themselves and highlight the key areas they're specializing in. Starting with you, Chaoni, please. Thank you.
Thank you very much. I think I have very, long titles. I work for BNP Paribas here and responsible for the APAC region. So a lot of my time is spending on working with clients, curating their sustainable capital raising activities, from establishing robust frameworks to advisory of, sustainability strategy. Very importantly, we are trying to connect eligible investment opportunities to ESG investors who are hungry, for these assets and quality of companies.
Okay, thank you, Chaoni. And over to you, Eric.
Thank you. I'm Eric Nietsch with Manulife Investment Management. In Manulife, we have operations in 11 different markets around Asia, and so I lead the ESG research and integration with those investment teams. So we work on incorporating ESG considerations into the entire investment process, and also on developing new. That's within our existing funds, as well as developing new dedicated ESG products.
Okay, thank you, Eric. So we'll get an advisory perspective as well as an investor perspective. And I think both of you probably have ideas from the other side as well. So why don't we get right into it? And my first question, just to ask both of you, but we'll start with Eric perhaps. When we talk about sustainability, sustainable banking, it's a very vague term, sometimes unhelpfully vague. So I'd like to talk a bit more concretely about what exactly makes a bank green. What does that mean specifically? Is it about the corporate strategy? Is it about balance sheet? Is it about other KPIs? Eric, please go ahead.
Yeah, it's a great question. I think it's in some ways there's some ways that you can think about what makes a bank green or sustainable in a similar way to how you can think about what makes any company green or sustainable. And what I mean by that is you can look at some of the operations that they're doing and the impact that those are having, as well as how that fits into the overall strategy for the organization. And so I think that applies to banks or any company that we would be investing in. And for banks specifically, and so the way that we approach that in our investment process is by, for every different industry, defining what are the most financially material ESG considerations, and how should those be considered when we're doing the research into the company and their strategy and their valuation. So with banks, we actually break it down even further, because I think there's also differences depending on whether you're looking at investment banking or consumer banking or consumer finance or mortgage finance, and the considerations within those might be different. And I think that's not limited to green. There are very, very meaningful social aspects that banks offer. And so I think it's, and then I think also like other companies, you can consider the footprint of their own operation versus the impact that they're having through the value chain that those operations engage with. So for a bank, that could be looking at their lending portfolio and all of the different companies that they're, companies or people that they're banking.
Okay, thank you. And actually, I want to follow up on that after I hear from Chaoni, especially on what's financially material when looking at ESG. So Chaoni, how do you look at this from your perspective? What makes a bank green? I know you work with a number of banks, but also your own bank. How do you define that, and how do you measure that?
I think I would like to start by saying, arranging green bonds or doing a few green loans does not make a bank green. I think it's way beyond transactional, when it comes to, a question like what makes a bank green or sustainable. And there are major areas for banks, should focus on in addressing environment, social, and governance related risks and opportunities. And I like to break it down into 4 major areas where I see really integral in making a bank improving, these ESG impacts. So I'd like to start with actually governance. It's very important for banks or any organization where the board and senior management have the right setup to be responsible for sustainability impacts, and as well as aligning the incentives properly, so that the ESG responsibilities are accountable. Apart from that, it's about how to engage across functions of the bank on this topic. So for example, at BNP, our board of directors validate the variable compensations granted to executive seniors based in part on the assessment of the group's ESG performance. So you can see the incentives are well aligned in terms of their compensation with the overall achievement of ESG on an annual basis. So there's no need to really to debate, the requirement or the materiality of ESG, in that sense, is really is really embedded well, from top down. Secondly, is actually risk management. I think this is extremely critical, for any financial organizations, how to identify, how to measure and factor in environmental, risks. For example, climate change, water scarcity, income inequality, so on and so forth. These macro factors have been traditionally left out of the sort of risk thinking. So given the major shift, in policy, in market environment, they become extremely material to any banks, because our clients are changing, the environment that we operate in are changing. So the risk function needs to reflect that appropriately. Therefore, change, rethink our understanding of risk exposure. And at BNP, we have identified multiple climate-related risks and opportunities over the short run, medium, and long run. And thirdly is how to translate them into products and services. And this part is just a lot more visible, right? We all see it, in the green bond market, in the green loan market. And we are really talking about the change based on the 2 points I talked about in our lending policies, in our capital allocation and capital raising activities, as well as investment opportunities. Today, we are one of the very few banks that have set a very clear timeline in exiting thermal coal, which is 2030 for OECD clients and 2040 in non-OECD clients. So this is real bread and butter for any banks doing financing activities. At the same time, we have we favor financing that is contributing to decarbonizing activities. So we have double project financing renewable energy. At the same time, we have made a commitment of a minimum 15% of financing directed to clients and activities that have a positive contribution to the UN Sustainable Development Goals. So So we are kind of changing the way we of our balance sheet, and also work very closely with our clients in the primary and secondary capital markets to help them raise capital, aligning the capital from the ESG investors to quality project that can bring positive environmental and social benefits to the society. And finally, it's actually transparency. Banks, as well as any financial organization, need to provide that transparency to key stakeholders like investors like Eric, how the banks are implementing and delivering, those areas that I mentioned.
Okay, thank you. Well, very comprehensive answer and some super interesting points in there. Actually, I think it's really interesting to hear the wide range of different initiatives within your bank approaching ESG. And perhaps I asked the wrong question. I talked about green, but really both of you answered about broader sustainability and not just about the environment, where I think it's fair to say the conversation is today. Now, you raised a good point about transparency. I also want to follow up with Eric on that. But before we do, back to the last question I had. Eric, you mentioned that you look at what are the most financially material ESG considerations, which I think is a very interesting question, especially from my perspective, because I'm not very experienced on the investor side. When you look at a bank, say, or maybe a corporate, whatever your experience is, what are the main, what are the main ESG factors that actually have an impact on financial performance and financial risk?
Sure. So, I think Chaoni touched on some really crucial points related to this. So, and I think that there's different aspects that you could look at within a bank. So, from a risk perspective, you could look at their balance sheet. So, like Chaoni was saying, where are they lending? Where's the concentration of sectors? If there was to be, say, a rising price on carbon that was imposed on the portfolio, what kind of effect would that have? How would that play out into the bank's performance and ultimately the valuation of their securities? It doesn't have to be, I think oftentimes when we talk about these topics, we think from a perspective of risk, which is very appropriate, but there's also opportunities that we can look at when you're looking at how a bank is positioning itself. So, I think, like you said, you can go beyond green, and you can look at what is their strategy for digitalization. Does that create opportunities for financial inclusion? Does that provide growth opportunity for the bank? What's that doing to revenue and margins? And really, like, also, like Chaoni explained, it's often all of that is largely dependent on what is the organization doing with its overall strategy and how is that governed at different levels of the organization. So how is the executive team thinking about these risks and opportunities? How is the board guiding the strategy and providing some continuity? So it's those are just a couple examples that I would mention.
Sure.
And really to kind of bring it home, like Chaoni was saying, as an investor, it's more challenging to get a sense of that if the company is not transparently reporting on it. We do engage with the companies that we invest in to have conversations with them and try to understand these issues more clearly. But I think the last step is how they bring it together and communicate that to the market.
Well, actually, if you don't mind my asking, when you talk about, obviously you cover ESG, you're an expert in ESG investment, but at which stage, so to speak, of the investment process does ESG enter? Is it something that is factored into credit risk? Is it something that is just an overall policy of any investments made by Manulife? Is it a combination? Does it depend on the particular fund or a particular portfolio? How does ESG kind of fit in now in your decision making?
Yeah, I think that's actually a great question. So what we're working on in all of our portfolios is what we call ESG integration. And so great, right? We consider these issues problem solved. No, it's it's something that we started a few years ago, and we think that it's an extension of just the natural strengths of our investment process as an active manager. But we do think it's something that takes a lot of time and effort to do properly and to do well. And the reason for that, as you point out in your question, is that we think it really has to happen at all stages of the investment process. So it starts with where we're sourcing information. So where can we find ESG data that could be in the form of third-party scores, or it could be raw data. But how do we make that information available to the investment teams, and how do they source that information along with the financial information and financial data that they're sourcing? Then how does it get incorporated into the research? So the way that begins to happen could diverge for our credit teams, for our equity teams, and what we work with them on is doing it in a way that's most appropriate and additive to their underlying strategy. And then you can also look at how these things come together at a portfolio level, through the portfolio construction, through the risk management process. And then once we have made those security selection decisions, it doesn't end there. So that's where, I briefly mentioned before that we can engage with the companies that we can invest in after we, go through this, incorporating all of these considerations into the research. We can then share that perspective with the companies that we invest in. So we can meet with them and say, these are some of the best practices that we're seeing in your industry or from some of your competitors. These are some risks that as investors we're concerned about, but we think that they're addressable. We think that you can take, you could consider these steps to improve the performance. And ultimately, if they're able to reduce their risks or take advantage of some of the opportunities within their business, then that should support their financial performance and ultimately our portfolios. So that's kind of the string of the different places where it becomes incorporated into the investment process. But what I also think is really exciting is these become self-fulfilling and circular. So as we're having those conversations, we gain a better understanding of their business. That helps us, further hone in and accurately come up with our valuations. So I think it's it's really important that it happens throughout the investment process. And gets tied to the underlying investment strategy.
Well, I like, that's a good point. And I think it's a good point about the circular process. I'm seeing that from the margins as well, where the investors are asking the questions and corporates are taking action, and then that leads to more investors being interested in the actions they're taking, and maybe they're missing out, or maybe they're not asking all the right questions. It kind of fulfills itself in a happy prophecy. Now, Chaoni, I'd like to get your perspective on this as well, because I know that you speak with all kinds of banks, corporates, clients across Asia Pacific in particular. And Eric alluded to best practices that are emerging in the industry with respect to ESG, and also some risks where maybe there are some gaps in what corporates are doing. Can I get your perspective on what you see, how you see banks changing today? Maybe not banks, but also corporates. What are some of the ESG practices that maybe didn't exist, say, 2 or 3 years ago, that are emerging today? And where do you think more work needs to be done at the corporate level, and perhaps at the bank level for many of the local and regional banks to improve ESG?
I like to use the green bond market as an example because, as
Sure.
the intermediates, we do work with all kind of, issuer clients and investors. So we can actually see the sort of evolution of change in terms of behavior. We step back a few years ago, when a corporate or any type of issue a green bond, it's very much, with the objective to get the green halo.
Right.
at the same,
to get the press release. Yeah.
Yeah, so the marketing benefit of issuing green bond.
That's right. That's right.
We've actually very quickly seen the objective or the goal has changed from a green halo to diversification of investors. So it has become or has changed from a PR tool to an investor relations exercise, which is actually very important, right? In aligning the incentives again, because if the focus is very much on getting the marketing benefit, then the focus is very much on, okay, make sure this bond, the framework is aligned to the principle, and I get the external reviewer and job done, because investor would just buy it. And also back then, investors asked a lot less question about, the issuers as a whole from an ESG perspective. So in the last couple of years, we have seen dramatic change in terms of the conversation and also investment selection mostly driven from the investors. So sophisticated ESG investors have already moved forward to include a very detailed analysis of the issuer's overall ESG performance. Even if you have a very strong framework that's aligned to ICMA principles, have ticking the right boxes with the second party opinion, it doesn't mean you are a green bond. Because when investors analyze that the issuer itself is not well aligned, to the overall ESG sustainability strategy, or the issuer cannot explain, the like climate change trajectory. There's no proper policy set up. There's no targets that they are aiming to achieve. Then it's become questionable of the ESG credential of the issuer. And investors, wouldn't want to reward this kind of behavior. Right? The purpose of allocating capital to support ESG is to see fundamental change at corporate level. So even in some of the very recent issuance that we have help, we have been, or the issue has been asked, a lot, at the sort of across the board level. Are you implementing TCFD? Do you have a climate target that's aligned with the Paris Agreement? And how are you dealing with board diversity, gender balance? So there's a lot of questions that is, have stepped outside the framework level. I think from that, you can see the evolution of change in terms of what investors are looking for and how issuers are also adapting themselves to make sure, their overall ESG credential and the framework, the issuance are really meeting the ESG investors, requirement, which I also think is a very positive change, driver in the market as we, progress, from the early days of green bonds to, a 2020 version.
Yes, and I've been there. I'm very fortunate to have been involved in the development of the green bond principles. It's a topic close to my heart, and I think you touched upon a very important point that many people may not realize, which is that the focus on the issuer's own strategy and own ESG credentials as a whole, as a corporation, as an entity, was not really there at the start of the green bond principles. When green bonds were first invented, I suppose, or when not invented, but when the principles were first formulated, I would say that the consensus opinion of the market, and the market was much smaller back then, was that it was all about use of proceeds. Right? It doesn't matter who the issuer is, as long as the money is being funneled toward the right investments, then that's great, that's additive, that's helpful for the environment, and we should applaud that. And I think that's a reasonable point of view. But what has happened in the market over the last, I'd say, 5 years is that the investor community has made it clear that they expect also not only proper investments and proper category of investments, but also overall good behavior on an overall strategy of the issuer itself. It's not just enough to be a brown issuer, so to speak, and just have a couple of green investments and chuck them into a green bond. You need to prove more than that. And actually the green bond principles, in a very subtle, kind of lawyerly way, have adapted to reflect that reality, where there's now a reference to the overall strategy of the issuer when it didn't used to be there. And so that actually, I think, is a major shift in the market. And the other evolution that you noted I think is also correct that green bonds used to be more of a kind of a PR kind of exercise, even though I think many of the issuers were themselves very green and very credible, and I think the instances of greenwashing were not very frequent. It was still just burnishing credentials that already existed. Whereas now, I think one of the main considerations or one of the main advantages to green bonds is getting an entirely new class of investors. We see that in Asia, especially, where if you're an Asian bank, you might get a certain group of investors interested in your vanilla bonds, and you can pretty much double that universe if you issue a green bond, because then you get all the global green investors interested in you. And I've seen that it's not only now I don't know if you agree, Chaoni, but it doesn't seem to be just a treasury decision anymore. It's almost like a CEO level, a strategy decision to issue a green bond. And so some of the issues about potential extra cost or pricing don't become as important as overall strategic benefit of issuing a green bond.
Absolutely.
Okay, but actually this leads me to another question, which I'd actually like both of you to answer. Of course, we talk about the PR benefit, we talk about the diversification benefit, we talk about the strategy rationale for issuing green bonds, but one rationale that we sometimes hear about is pricing. And obviously this is a tricky one, right? Because if the pricing is better for the issuer, then perhaps it's not better for the investor, and vice versa. But you do hear in the market, and I have seen studies that imply that from the issuer point of view, issuing green bonds, for example, can offer better pricing. I'm curious, maybe get a little bit technical here, but I'm curious, maybe Chaoni, you can start what you've seen in the market personally and what you think the evidence is for this, pro and con.
That's a very good question, and something that every single time
of course.
when we do,
I'm sure I'm not the first one to ask. Yes.
And I always defer the question to the investor, because the pricing the investors like many.
Well, he's here too. Okay.
But typically, we do see, across the board, because we have also analyzed, the sustainable bonds have been issued so far, and we also look at the APAC subset to sort of draw some concrete evidence to substantiate our claims. So across the board, we actually do see a certain level outperformance, maybe not very significant. So we look at new issuing premium. We look at pricing compression, from initial price guidance to final price guidance, when they close the book, as well as oversubscription. I think oversubscription has been very clear, have been demonstrated from study to study, that green bond or sustainable bond in general can attract a lot more investors into the book, which in turn can actually give a little bit negotiating power to the issuers, right? But for the pricing compression, what we can see on average is about probably 5 basis points, over time, for the sustainable bond issuer compared to equivalent conventional bonds. So we always share that with issuer that there's a bit of pricing benefit, but it's just not significant enough, because we also need to think from investors' shoes that over years we have been saying ESG investments does not sacrifice any returns, right? So on one hand, investors are very keen to support sustainable bonds. So you could see they really have dedicated capital, dedicated funds, or they have an overarching ESG investment commitments to support these instruments. But they are not taking on additional project level risks, even though we are ring-fencing to eligible projects. So we're still looking at issue as a whole, right? So
it's from a legal point of view, it's still overall credit.
So I think probably the bigger fundamental question is that, can ESG change credit risk, right? If the credit signals change as a result of better ESG or worse ESG performance, and therefore would affect the credit exposure of the issuer. So I think when the day comes, then difference can be maybe more significant. But we actually do notice pricing differentiation or cost benefit, to the issuer in the very recent sustainability linked bonds, which is newly released by ICMA in early June with the sustainability linked bond principles.
Right.
There are two precedents in the markets now with the Italian utility provider Enel and Brazilian paper company Suzano, which we are very fortunate, to be in the sustainability advisory as well as the transaction. So from both deals, we actually did notice, in the final pricing, there's about almost 15 basis point discount to the fair value of the issuer, which is a strong demonstration, of the amount of support from the investor community. But the other side of the coin, that 15 basis point pricing discount to the issuer is that if the issuers could not achieve the target set in those bonds, there's a 25 basis point step up in the coupon, right, as a punishment. So I think it's more or less symmetric that there's upfront benefit, but if you don't achieve, then there's also a negative incentive there.
That's right. And sorry, before I get to Eric, I mean, I just want to comment that it's a tricky analysis, right? I mean, first of all, comparing vanilla bonds to green bonds of the same issuer, I mean, I think has its advantages. I mean, it's useful, but of course, in the market, they're generally fungible in terms of credit. So it becomes a little bit tricky. Why are you necessarily comparing the two? And then also, I think you have a very good point that it's not maybe about comparing different types of issuances from the same issuer, but about looking at how the issuer's own credit profile and credit risk is changing by embracing sustainability through the products that it's issuing. I think that's a very interesting point. And yes, sustainability-linked bonds, that has just been, the principles have just been released by the Green Bond Principles organization, which ICMA serves as the secretariat of. And we've seen some issuance, not much issuance so far, but as I understand in the industry, there is a pretty robust pipeline. It's just kind of ironing out some of the details. And because these are more technical types of bonds, you would be closer to these discussions than I would, but I understand that it can be quite tricky discussions sometimes between the issuers and the investors. Is that right?
Absolutely.
Okay, so maybe I'll ask a slightly different question to Eric, maybe not as much about the green bond market itself, because I think the jury is kind of out, but maybe a more general question in terms of ESG itself. I mean, where do you see, let's say, improved ESG actually resulting in a better risk return profile? What aspects of ESG really matter? Which ones don't? Are there differences in the time profile? Are there differences in the types of banks or types of companies you analyze? I know it's a very broad question, but maybe you can get into a bit more detail about where it matters financially and where it doesn't matter so much.
Sure.
Even perhaps negative.
Well, and if I can, let me answer that first by just kind of continuing to run with the the comments on the green bonds, because I think it extends. I think a lot of the benefits that we see there extend into how we think about the ESG benefits throughout the portfolios overall. And so I think as you were rightfully pointing out, when in the sustainability linked bonds, it's specifically linked to the coupon. So it's specifically linked to the financial performance in some ways. So I think that kind of answers the question in itself. Right. On the green bond pricing, I think it's kind of the piece of performance that maybe, I guess we get more excited about the benefits in other parts of the performance. So the pricing is only one aspect of the performance. I think in everything that's gone on this year and how disruptive it's been, we've seen a big volatility difference, where the volatility of the green green instruments has been a lot less. The drawdowns were a lot less through the pullback.
But if I may ask a somewhat perhaps nerdy question. Do you think that lack of volatility is more due to fundamentals about ESG investments or corporates, or is it more about kind of the buy and hold nature of the investors?
So I think it's hard to pull the two apart. I think it's probably got to be some mix of both. I think either way, the buy and hold and the diversification of the investor base, those are all things that are probably benefits for the company in terms of access to funding and future cost of capital. And so I think those are important. I think those are also important to investors from a credit risk perspective when we think about things like refinancing risk. And then I think that there are other benefits where, when a company goes through the process to issue their first green bond, how much more are they looking at these issues in their business? How much more are they thinking strategically about how these can benefit the financial performance of their business? Does it also create an opening where we can then have a more meaningful conversation with the company, express to them what we view as the risks and opportunities that they can address? So I think it creates all of those opportunities for improving the performance in the future. I think also when I extend that from green bonds to our entire portfolios, we've just, and I guess if I use one specific portfolio, we've just launched a dedicated Sustainable Asia Bond Fund. And what we see with that is we don't have to give up returns to get a very large difference in the footprint. So if we look at the carbon footprint specifically, historically the return is quite similar to what you would get with a higher carbon footprint. So we're not giving anything up, but I think that it's only scratching the surface of the future performance. So I think that something like that is going to is inevitably, just following the science, going to be more financially impactful on companies. So I think when we raise this question about performance, it also gets into the question of are we addressing it on a look back basis, which I think often won't be representative of some of the benefits and the performance that we'll see in the future. I think that also raises the question of time frame, which you also brought up. Climate change is very long term. It's going to play out over many years. I think in terms of best practices, from what we can see, like Chaoni said and is doing herself, it's helpful to have short, medium, and long term targets. But that's one issue, and it could be very different from water scarcity, which could be very immediate when it happens. It's different from social trends, which might play out over a more kind of medium term time horizon. And it's a very roundabout way of answering your question on where it's most important, because I think it is hard to generalize. I think you have to consider different issues over different time horizons, and which issues are most important in different industries, because I think it varies across those as well.
Okay. Sorry, one quick side question. You mentioned your sustainable bond portfolio that you launched. I don't know how much you're able to say about it, but I'm just curious, how do you define sustainable bonds? Are you looking for actual kind of self-proclaimed sustainable bonds, or you have a different way of looking at that from the issuer perspective? Yeah, obviously, supply is not catching up to demand right now, it seems.
So that's a great question, and I should have been clear about that, because when we say sustainable Asia bond portfolio, it's it's not what we mean is it's not only green, social, sustainable, transition, blue. It does have a dedicated allocation for those instruments, and so we've committed to a minimum 10%. I think that will rise over time, and what we want to do with that is support the market as it's growing. But what we're also looking at is Asian bonds and the sustainability across that bond portfolio. So a lot of it is instruments that wouldn't fall into that category, but where we're doing the credit work, doing the ESG work, thinking about these underlying issues, and targeting specific themes.
Okay, so it's a more fundamental analysis then that you're doing, even broader than the green and social bond world that we know and love, which is still a very tiny part of the bond market. Well, I'm sorry to say we're almost out of time. We have a couple of minutes left, and there's one topic that I did want to get to and ask both of you to comment on, which is a very big question about official sector involvement in Asia Pacific. So one thing that we've seen, again, talking about the evolution of sustainable finance in Asia, is that the development in Asia has been largely led by the official sector, meaning regulators, meaning the involvement of central banks, environmental ministries, et cetera. And I personally think it's been a very good thing across the region. But there are a number of different tools they have to use: disclosure regulation, capacity building, banking regulation, supervision, prudential supervision, taxation, grants, all these sorts of different things. And maybe I'll ask Chaoni first to comment on what you think are the most effective tools and policies for the official sector to help promote sustainable finance in the near future. And maybe if there are ones that you want to mention that you think are less helpful, where we should probably let the market work it out on its own.
Great. Well, that's a very big question, and I think there's no single bullet, to address it, right? So I think it's equally important to develop, the right regulatory tool, as well as, capacity building and incentivizing the market. So I think, in Hong Kong and in Singapore, just an example, right? Recently, we have seen the monetary authorities in both markets rolling out their assessment framework to see how ready, how prepared banks are in managing, climate change and environmental risks. So I think that's a very systematic approach to deal with that, so that banks across different levels, from or different size and experience, starting to systematically look into the governance setup, the risk assessment framework, product, as well as transparency, so on and so forth, in managing this risk. So I think this is actually fundamentally important if we want to scale up, sustainable banking across the region. So I would think this is actually one of the most critical first steps, and we're really pleased to see the authorities are doing that. And secondly, I think capacity building is very important because not everyone is at the same level when it comes to implementing, ESG across their organization, right? So it's important, apart from, the stick, we also need to provide, the right content or the capability across the board, so that everyone is really growing the awareness, growing the capability to do so. And what I found, and a third point I want to mention is taxonomy. Certainly there's a lot of focus on taxonomies now, certainly with EU leading the way with EU taxonomy, and we have seen in mainland China have the green bond standards, and certainly it's also being revised to have a common standard across China to guide domestic issuance, right? But is it helpful to have taxonomy in each of the local markets?
Good question.
Yeah, I think that really requires another hour for us to dive into it.
Yes. Agree.
But the whole answer would be, the market has been performing very well. Certainly, we want to prevent greenwashing, and perhaps transparency is also a very effective tool to prevent that. and investors also have, their range in terms of, how green they think is green, to align with their investment strategy, right? So I think market also, market has been doing very effectively in rewarding credible issuer when it comes to green. And perhaps it's not realistic to have a common, completely harmonized, framework for global, for the entire market global. That's just my personal view, but but I see a lot of effort, going into the local taxonomy development now.
Right. Okay. Eric, how about you from the investor perspective? What can the official sector do, or what should they avoid doing, in order to increase the volume and quality of sustainable investments for yourself?
So I completely agree that there is so much going on with the regulators and with other bodies around frameworks, standards, taxonomies, and I think there is value in having harmonization across those. I think there's also, I think the challenge that the regulators have is trying to define something and take the lead, while also allowing for flexibility for the market to continue to define things, or for companies or banks, and so I think that creates value in kind of the idea of flexibility within a framework. I think what the International Capital Markets Association has done with principles is along those lines, that it can create an appropriate amount of flexibility, while also driving the entire industry, and continuing to drive the industry in the right direction. One thing that I think has been very welcome from my perspective is, I think the regulatory bodies in Asia have been very collaborative. They've opened opportunities for us to submit to consultations, and to provide, they'll provide drafts, and then engage investors like us to provide feedback, and I think that's really helpful. I think in some ways it's very welcome that we can work together on the developments, and so I think that's been really positive.
Okay, thank you very much, Eric. I'm afraid that's all the time we have for this panel. We have a few topics that we could talk about for hours and hours more. Transparency, taxonomies, data, regional issues, but I think we'll have to stop for now. Thank you both, Eric and Chaoni, for your expertise, your insights. I really enjoyed this discussion. I appreciate your candor as well. And thank you to the organizers for inviting us. That wraps up this panel. Thank you very much for listening, and have a good day.